This is part 3 of a 3-part video series where we look at numerous possible outcomes for stocks, bonds, and commodities. At any time, you can hit the pause button in the lower left-hand corner of your video player if you'd like to review a slide in more detail. Based on Newton's law, we believe the base case has now become either a multi-week low is already in place, it's running neck and neck with lower lows, and a possible multi-week rally following those lows. In this video, we examine these markets along with several others. If you want to skip ahead to various portions of the video, you can use the circle on the bottom of your video player to move forward or backward. Sir Isaac Newton gives a slight edge to the bulls. Newton's first law, an object in motion tends to stay in motion unless acted on by an outside force. That just tells us that the short to intermediate term momentum in risk assets is to the upside, and unless something happens, that will most likely continue. As we all know, a potential candidate to act as an outside force could be anything coming out of Europe, especially with a very uncertain and unstable situation in Greece. You can use this icon in the lower right-hand corner of your video player to view in full screen mode. This icon allows you to improve the image quality and clarity of the charts. It's Saturday morning, June 15th, before the elections in Greece. This is a monthly chart of the NASDAQ Composite. This is price. This is the 17-month exponential moving average in blue. Currently, the things that we would look for: when the slope of this line is up, good things tend to happen. When it rolls over, bad things tend to happen. When price is above the line, good things tend to happen. When price is below the blue line, bad things tend to happen. Currently, the slope is flat to up, which has a bullish bias. Price dipped below the line recently, as it did here. We're back above the line. As of mid-month on June 15th, this chart leans towards bullish outcomes. However, the important thing is where this chart finishes at the end of the month. This is a daily chart of VEU, the Vanguard All World Index. You can clearly see the inverted head and shoulders pattern here. Shoulder, head, shoulder. It's not the cleanest thing on the planet. This is the neckline here. If you hypothesize what the target could possibly be, it takes you up roughly to 4150. You can also see that this downward sloping trend line intersects roughly in this area. So this chart, coupled with some PE ratios relative to what PE ratios look like at bottoms in 2010 and 2011, you can add into that some very concerning and ugly looking monthly DeMark charts, tell us that it's possible that even if we move higher here, that prices will be rejected and this longer term downtrend could remain in force. The way that we've played this so far is any moves that we've made to the long side in the last 2 weeks, which was roughly here and here, we're not making long-term investments. We don't believe this is a period, or that we have enough information yet to say that I want to go out and buy stocks that I want to hold for the rest of my life. There's just too many unknowns, too much risk in Europe, and too many unanswered questions from a technical perspective, including the fact that we have not cleared this downward sloping trend line here. This is the same chart we just looked at. We're just taking a little bit closer view. This is the shorter term downtrend that was steeper. You can see we broke the trend line here. We came up here and made a higher low relative to this low. And then on Friday, we made a clear higher high. These are the 3 steps needed for a basic change in trend. So you can see that this trend line has been broken, but on the previous chart, we showed you that the longer term downward sloping trend line could come into play again somewhere in the neighborhood of 4150. So like most of the charts we've shown, this is a mixed bag. It leans bullish for the short term, but by no means do we have an all clear signal yet from numerous perspectives. We're just going to see if we can get up here. If we do, how does the market react in this area? This is a weekly chart of the German stock market, or the DAX, that we've shown several times over the past few weeks. We hypothesized that if prices didn't hold in this support area here, which they did not, that the next stop would be around 1660, which is this orange line. As you can see, we came down to the line and we've bounced. For now, the support seems to have held. As you can see, there's numerous areas to act as potential resistance above price, but for now, this tends to lean bullish as well. This is a chart of European financials. This is a downward slope here. If we drew a trend line here, you can visualize it. It was broken somewhere in here. We came down and made a higher low relative to this low. And on a closing basis, which is this line here, we made a new high. This meets the criteria for a trend change, a bullish trend change in European financials. We'd prefer to see price move above this level here. So this is somewhat concerning and somewhat neutral, but if we just drew a line based on closing prices, this would look pretty good. We've discussed this weekly chart of EFA, foreign stock ETF, several times in the past few weeks. Shoulder, head, shoulder. This is the neckline, which acts as support. So far, it held here, here, here. We've come down now twice in the past 2 weeks and tested this neckline, and it appears as if it has held. If it doesn't hold, the target for a break of the neckline would be all the way down somewhere in the region of 33.50, and that represents roughly a 28% decline from the neckline. A head and shoulders pattern does not become bearish until you break the neckline. So for now, in this chart, the bulls have the upper hand. This is a similar chart of EFA. There still is some cause for concern if you look at this trend line here. We've come right back up to the trend line here, which could act as resistance. So there is still some hope for the bearish case if we bounce off here and go below 46. An update to the weekly version of RSP, which is an equal weight S&P 500 ETF. Good things tend to happen above the line. Bad things tend to happen below these two blue lines. We've been testing this support area as well as this 50-week moving average, which closed Friday at 47.39. Price closed at 48.57, above this 50-week moving average. So we're above this blue line, we're above the 50-week moving average, and we're above this blue line. So if you're bullish, you'd like to see this high taken out, and you'd also like to see this line turn up. This big picture tends to lean bullish, but it still has neutral/bearish components. This is another chart that we've shown several times in the past few weeks. S&P 500 daily. The blue line is the 390-day moving average. You can see in the past it has acted as support. This is 2005, 2006. Currently, it appears that we've come down and tested the 390-day moving average and held. You can also see that the 390-day is starting to tick up right here. So all things being equal, it's bullish when the slope of the line is up and bearish when it's down. Prior to the election in Greece, which obviously can change things, this chart too favors bullish outcomes. This trend line here has been drawn all the way from the 2007 October highs, acted as resistance, bullish breakout, gains followed. We came down and we've tested this line 1, 2, 3, 4 times. It appears that we've passed this test. The most important thing here is that price on this chart is now above price for the last 1 to 3 weeks. As long as we stay above this line, it favors bullish outcomes. This is a daily chart of the S&P 500, another that we have shown in the past several times. Kind of a noisy chart, but easy to understand if you take things in isolation. This pink line here is the 200-day moving average. Here, things did not look good at all. We're in a downtrend and we broke the 200-day. Since then, things have improved. These are moving averages up here, these thin lines. You can see when they rolled over here, that tended to be bearish for price. Come down to the present day, flat tends to be good, turning up bullish, trying to turn up here bullish. Still a potential source of resistance. This is the 50-day moving average. Potential resistance, we cleared it. Potential resistance, we cleared it. Potential resistance, we've cleared it. This line here may have been the most important development on Friday. During the vast majority of the trading session, we were below this pink dotted line. Prices were able to close above it, which, like most of the charts we've seen, leans towards bullish outcomes, using the caveat of Newton's law. We just broke above the pink line here. We may move relatively quickly towards 1365. However, we do have a ton of uncertainty this weekend, potentially coming out of Europe. This is the original bearish head and shoulders that we presented somewhere in this area. The blue and the green line were hypothetical targets that we discussed when price was up here. As it turns out, the line that we drew near 1280, which is actually based on this low here, which I believe is 1277, if you come across, it worked like a charm. Sometimes head and shoulders patterns work extremely well. They don't always work, but in this case, it appears to have worked well. We've held here, and it appears that we are now passing tests. You've got line coming down here, a higher low relative to this low, and now a higher high. The thing to keep in mind here, if you're a bull, this neckline, what once was support, a little bit of support, may now act as resistance. So if we are able to move higher, this would be a logical place near 1370, 1368, and then again around 1390 at a minimum for a counter trend rally and possibly a bearish reversal. Quick update to this monthly rate of change chart for the S&P 500. When rate of change crosses this center line, good things tend to happen for price. This is the S&P 500. When rate of change crosses below the center line, bad things tend to happen for stock prices. This is indecision. The bullish trend was able to continue. We've been in indecision/bearish mode. We dropped below zero. As of Friday's close on June 15th, we're back above the center line. As long as it holds, it tends to favor bullish outcomes. Updating the Fibonacci retracement levels. This is based on closing prices, daily chart S&P 500, October low, spring high. You're looking at retracing these gains here. A 61.8% level was at 1297. You can see it acted as support momentarily here. Then we came down towards this 1260 level, which would be this retracement level here. For now, both of these areas appear to have held. The more important thing that may have happened on Friday, these parallel trend lines here and here, looks like we closed above this parallel trend line here, which is another bullish development as long as it holds. This is another chart that we've shown numerous times over the past few weeks. It's a weekly chart of the S&P 500. These are parallel trend lines going all the way back to the March 2009 lows. When we were up here, we hypothesized that price could potentially hold at this line. You can see it acted as support here, here, and here. We also hypothesized that if this blue line did not hold, that we could come all the way down towards this pink trend line. We've got resistance in here, this thin blue line above 1350. If we come up here and bounce down, we still could come down near this 1250 level. Just have to keep an open mind. If we can clear this level here, we've got some potential resistance in the form of this green line. If not, 1440, 1450 starts to become real. Support here, where do we move? We move back up to this blue trend line, which is all the way up here. Support here, where do we move? All the way back up to this upper blue dotted trend line. If that pattern continues, we would move up to this line. We still have to clear some hurdles here, and if we do not clear those hurdles, this pink line could still come into play. This is a daily chart of VEU, another one we've shown several times. When these moving averages, this is the 20-day moving average, rolls over in a bearish manner, rolls over in a bearish manner, bad things tend to happen with price. When it turns up, good things tend to happen. Currently, rolled over here, bad things happen. Currently, it's trying to turn up in a bullish manner. Here's the trend line from the October lows. It held here, hasn't been as clean here, but it appears that once again that it's held. While we believe that most of the charts are leaning bullish in the short term, and we have done some buying in the last 2 weeks, we also understand that we still could come down and make a lower low. This is VEU, a daily chart. Again, we're looking at parallel trend lines. We've got potential resistance here in the neighborhood of 40. If this acts as resistance, we could come back down towards 3750. If we're able to clear 40, we could move relatively quickly back up towards 4150 all the way to 4250 on VEU, the Vanguard All-World ETF, sans the United States. This is a relatively positive move in MACD histogram off of this low. You can see it's been quite a while. You have to go all the way back to the October lows to see a MACD histogram as powerful as the one that we've seen off of this June low. We're in somewhat of an indecision mode on this chart. The good news for the bulls is the moving average is trying to flatten out here, which is the first step before you can turn up. This is still very indecisive here. The other potentially bullish developments, one that we noted last week, is MACD histogram. These blue bars has ticked up 2 weeks in a row. These MACD histograms ticking up can foreshadow a bullish cross in MACD, which is when the black line moves above the red line. Typically, when you get a bullish cross in MACD, especially on a weekly chart, good things happen in terms of price. We have these ticking up. We don't have a bullish cross in MACD histogram. We do have a black MACD line that is trying to flatten out, similar to this moving average here. Also some indecision in ADX. The black line has not rolled over. This is still favoring bearish outcomes. If you're a bull, you'd like to see this line start to flatten out and roll over, similar to this period here. Price advance followed soon thereafter. We'd also like to see this green line eventually cross above the red line. When green goes above red, that's a bullish signal. Good things happen. Somewhat of a mixed bag here. The short-term trends, like most of the charts that we've looked at, this red line coming down falls into that camp, seem to favor the bulls. However, the bigger picture is neutral to bearish on this chart. Just a quick update to this weekly chart of the volatility index. When the VIX spikes, that's a spike in fear. Bad things tend to happen in stock prices. This is the S&P 500 here. Really the only point we want to make here is MACD histogram is now ticked down 2 weeks in a row, which tells you that the momentum, upside momentum in fear, is also ticking down. MACD ticks down. It is part of a bottoming process here. So all things being equal, this also leans towards bullish outcomes. MACD is still above the red line, the black line. So similar to the previous chart, big picture, this chart leans bearish. The shorter term trends and momentum, the bearish momentum, is waning, which leans bullish. This is a chart of copper that we wanted to show last week. It was listed in part 3. This is MACD. The slope of this line is up. As price is sloping downward, that's a bullish divergence that we wanted to point out. We've broken this bearish trend line for the most part off of the May highs. MACD now on a daily chart is up 1, 2, 3, 4 days in a row. Tends to be a good sign when you get this bullish divergence and then you get MACD moving above the center line. So all things being equal, on a very short-term basis, this chart aligns with higher highs relative to this high in copper. Let's assume for the moment that Newton's law remains in play and that the shorter-term bullish momentum continues. Would you rather be in stocks or commodities at this point? This chart can help us. This is a weekly chart of the CRB index, which is a basket of commodities relative to the stock market. So when this line is falling, stocks are strong relative to commodities. When this line is rising, you'd rather be in commodities relative to stocks. What do we see here? We see, for the most part, commodities being weak relative to stocks. You're making a new low in the ratio relative to this low in 2009. So this is a downward sloping trend line. You've got a bullish divergence in MACD. This tells you to be open to commodities picking up steam relatively soon relative to stocks. You can see here on this trend line, commodities outperformed stocks for several weeks. Near the trend line here, commodities outperformed stocks for a very long period of time. We're back down near the trend line. It appears as if we're trying to hold here. RSI can help us here. Currently, RSI is still below 30, which is bearish for commodities relative to stocks. When RSI on this chart can reach 50 and exceed 50, if we move up here, it tends to open the door to bullish outcomes. You can also get a head fake, so it's not a clear signal. Here, it worked better. You can see here we went above 50 and came back down. Not good if you're bullish on commodities relative to stocks. If you're bullish on commodities, this is what you want to see. You want to see RSI on this weekly chart of the ratio clear 50 and stay above 50. You can see after that happened, commodities significantly outperform stocks. We're really nowhere near that point here. Currently, we're down here. Commodities have a lot of work to do before we would become overly interested, but we have this bullish divergence here relative to stocks, and we've hit this trend line. This is just the CRB index, or a basket of commodities, and you can see after this point here, commodities performed extremely well. This was another chart that we wanted to show last week in part 3 of the 3-part series. We just didn't really have time to show it. This is the S&P 500 relative to long-term treasuries. So think of this as the ratio of risk on to risk off. When this line is falling, that's risk off. When this line is rising, that's risk on. These are parallel trend lines, these black lines. This is just a simple trend line, another simple trend line. This goes all the way back to the March 2009 lows. Typically, when you bounce off one of these trend lines, you can see the intersection here this is the stock market. You can see after we bounced here, this correction in stocks ended and stocks moved higher. In a similar vein here, when we hit this trend line, this orange trend line here, stocks moved higher. Where we are now is here. This is a weekly chart. So 3 weeks ago, we hit this black parallel trend line and this upward sloping orange parallel trend line that's based on the March 2009 low and the low here in late 2011. March 2009 low, stocks performed well. This low late in 2011, stocks performed well. We've got two of these trend lines here, which tends to be strong support. What it's telling us is we have a setup similar to this period here and similar to this period here. It also has similar characteristics to this period here. All of those periods led to bullish outcomes. As long as we remain above this orange and black line, it favors the bulls. This is a weekly chart. We could see potentially a multi-week rally in risk before we run into resistance here. Obviously, if we reverse and move back below this orange and or black line, that's bearish for risk and bullish for treasuries. This is another chart that we wanted to show last week in part 3. This is the Philadelphia Semiconductor Index, affectionately known as the SOX, SOX. If I connect this price low here and this price low here, I get a downward sloping trend line. MACD, which helps us monitor bearish momentum, has an upward sloping trend line. Not a huge divergence. Gets much, much better recently here. This is a bullish divergence that we noticed last week. This is Williams percent R. What you want to see on a rally is you want to see Williams percent R at least get to this negative 20 level. We just barely eked out above negative 20 as of the close on Friday, June 15th. We'd like to see the SOX clear this high here above 380 before we become a little bit more constructive on semiconductors. The short-term trend holding at this trend line and this divergence in Williams percent R tells us to keep our eye on potentially bullish outcomes for semiconductors. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.